Hello, my name is Daniel Young. I'm the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so you can pass your wealth off to the next generation. This is kind of the witching hour at my house. It's cat feeding time. So who knows where those little mongrels are. Um, Cicadas are firing up. You might hear a fan in the background. Um, yeah, lots going on for the end of the day. So if you've seen any of my past videos, hopefully you understand our investment strategy using closed-end funds. And understanding that strategy is key because I'm going to apply that strategy and take that strategy and apply it towards sifting and filtering out financial memes. The vast majority of these memes are just trash. I found some decent ones, but the vast majority of these memes are just trash. So reminders, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. And if I show our strategy of using closed-end funds specifically, I'll kind of briefly go over that, which I'll get into that a little bit tonight. Disclaimers, see the description for the full disclaimers. The only two I'll mention here is that I'm not a financial advisor. I am a financial strategist. And sometimes I walk alone and I'm comfortable walking alone. Um, if you know what you're doing and you know what you're getting into and you're ready to make that investment, then be confident in what you're doing. Be confident in what you know. And if nobody else is saying it, by all means, take their advice, right? But at the same time, if you're going to move away from the herd and do your own thing, don't be afraid to do that. So my goal in making these videos is not to trash people. I mean, the people did put a lot of work and effort into making their financial memes. But at the same time, you and I want great advice. And there's a lot of advice out there that is not great. So I'm going to attempt to filter out and sift through all these memes without outright trashing anybody because I don't want a libel lawsuit. I don't want to slander anybody, but I am very interested in separating the good from the bad. So let's see where we are. So this is the end of the end of my financial meme board on Pinterest. There's 450 current files. I've started at the bottom and just slowly working my way up. And this is what we're looking at tonight. And that's this page. So their advice, invest $5,000 into these stocks. And here's how they rate, or here's what they say you'll get, and then how many dividends that'll pay. But I always like more data. Like I like it broken down in a different way because this looks pretty, but that doesn't mean it is pretty. So if we come here, we'll get to this one here in a little bit. But right now we're going to look at the, let's see, how many are on here? 1, 2, 3, 4, 5. So we're going to script. We're going to look at 4 of the 5. So Coca-Cola currently is $60 a share, $60.50 a share. They're paying you 46 cents for every share, $1.84 on the year, and $5,000 will get you 82 whole shares, which will give you $150 on the year for 3%, like a 3% dividend, 3% yield. So let's see, Coca-Cola, 142, currently paying you a little more. Pepsi, same thing, quarterly, cost of a share, dividend a share, dividend a year off one share, 5,000 investment, how many whole shares you get, which doesn't, I updated the spreadsheet. Maybe I didn't update everything on the spreadsheet. Let's look. Divided by is 82. That's still accurate. 27, that's still accurate. All right, so we're good so far. Donald, 17. Price went down a little bit. 57, same thing. Price went down, you get more shares. So I won't keep reading this information to you because you can pause the video and look at it yourself. Um, these pay quarterly, that pays twice a year, semi-annual. Make sure. Yep. So if you bought these four companies at 5,000 a piece, so $20,000 investment, you would get this amount per year and just a 2.4% annual dividend or an annual yield. Inflation, the Fed can say what it wants, but the inflation's really about 4% right now. So on dividend alone, you're losing money. And if we look at all of these, so none of them pay a competitive dividend to investment or a competitive dividend to inflation. So stock price matters because everybody wants to sell higher than what they bought. But stock price only matters if you sell. In the meantime, the dividend you collect, if it's not going over inflation, you're just losing money. So Coca-Cola could say, well, heck, we'll gain, 10% in 5 years. Okay, well, if they're losing a percent a year just to inflation, it's not a 10% gain. It's really a, say, 4, so 1, 5%, 10, yeah, you're not making 10% for the year or over those 5 years. You're losing money. You're losing a percent a year, so you're really down 5% on your original money invested. That's why I like closed-end funds. So instead of me attempting to diversify, right? I'm not just in Coca-Cola. I got their competitor Pepsi. So instead of me diversifying and spending more money on both to get a shitty dividend on both, I can buy one company who owns those and actually owns all four of these and actually owns a lot more companies. This closed-end fund owns a lot of companies and it diversifies for me. Now, closed-end funds, you can look at targeted sectors. There are MLP, natural gas, pipeline, utility. There are closed-end funds that are just they're just communications, they're just consumers, they're just pick your corner of the market. You can also find closed-end funds that are like portfolio McCann, right? Which is what GLO is. And if you come up here, this is the website I start with for closed-end funds. You just type in GLO at the top. It'll take you to this page. And it'll give you the basic info for the fund. It'll tell you the current discount. Closed-end funds are called closed because it's a closed system. They only have so many shares. So supply and demand works and actually works on closed-end funds. If Coca-Cola ever runs out of shares, which isn't supposed to happen, right? But if Coca-Cola ever ran out of shares, they could simply write you a new share on a make-believe sticky note, and that cost of a share or however many shares you buy doesn't actually influence the cost of the overall like the buy-in cost for everybody else. Closed-end funds, if a lot of shares open up, prices drop. If shares become hard to find, prices rise. So paying attention to this overall discount is important because you come over to the overall pricing page and you can see the discount over time as well as what it is the last 5 years. So if the current discount, $14.92, is equal to or greater than twice the 5-year discount, So the 5-year discount, 8.7, would be close to 17.6, right? Versus the overall discount, you're looking at something, I don't know, maybe around 11, roughshotting it. So is it greater than those two metrics? Yes. But it becomes significantly different when it's at least double the metrics. Or in a fund that hasn't been around that long, like if a fund's only been around 3 years or really a year, you can be a little more lenient in how much discount you're willing to give it credit for. So GLO on my watch list, it's on my watch list and we own the company. But at the same time, it's not on the target, like it's not on the initial price alert list because the discount does not hit that double level. Now, is it still a good buy? Yeah. If you look at the price overall since inception, it's pretty low right now. And GLO, it's a portfolio in a can, but it's this swinging fund or roller coaster ride. So if you catch it on the swing, like if your goal is to keep it long term, then you're going to be set up for some swings. And it's like a 2-year pattern almost. And it just bounces from highs to lows. But at the same time, they pay a really nice dividend. They decrease this dividend and it still pays a fat dividend. Prior, it was paying upwards of 20% a month. So strategy. So if you're a buy and hold, then you're buying low, enjoying the ride on the high end, waiting for it to dip, buy again, right? Let it come up, buy again. Or if you're selling, so you're buying it low, and then when it spikes up again, then you're selling, reinvesting the money somewhere else, and then you'll pick it up again when it's low. That said, this discount doesn't make it as appealing as maybe 10 different funds right now that are historically, that are below, or say more than twice below, however you want to say that, below the historical discounts. GLO is interesting for us because we own it. This is below our buy-in price, so it would be a great dollar cost average pickup. It's great overall compared to where it is. It's ready for another bounce pattern. If you were not, say if this was not enough, which I don't blame you, I mean, it's got 144 different holdings. This is just the top 10. If you wanted more, you could type in GLO portfolio Morningstar, and Morningstar will show you the top 25 funds they hold. But getting back, so if you're willing to diversify on your own and buy these stocks for $5,000 a piece, right? So you've got a 20 grand investment. You're getting less than $500 off your 20 grand, which is not that great. Or you could snag, say, we'll take the full 20 grand that you would invest into these and plunk it into just one fund who owns a lot of other funds. Then you end up with, we'll check the shares, 5,000 divided by current pricing. That seems to be off. 20,000 divided by current price, 4,032. So you would get that many single share or that many shares of this one fund and that dividend. So you compare 23 to 491, significantly different. And that's your return just based on dividend alone. So you look at that return or the annual yield versus that annual yield. And this is more appealing. So I can buy in lower. I can get a better dividend. I can work this into my portfolio to say, work it into our goals of retiring on dividends and not selling principal. And the fund diversifies for me. I can buy and hold it, or I can sell it when it's high and reinvest the money and just kind of swing on to the next one. and they will amend their portfolio when that discount rises to twice the historical average. The company management kind of gets a indicator like, hey, we need to change strategy, and they'll change their strategy. And the discount will drop, the price will rise, they'll restructure their holdings to fit the current economy, right? And as the price goes up, then you get to figure out if you want to ride that wave or ride that ridge for the next 2 years, collect the dividend, let the price go up and sell it, or collect the dividend, watch the price go up, watch it come back down, buy more, watch the price go up. You get the point. So I'm not going to get into more. I don't like when people browbeat me with info and just restate info. I'm not going to do the same to you. Uh, for me, it's pretty cut and dry. For you, I'll let you decide. For us, and on our end, we use closed-end funds. You can still diversify if you want to, but I want to say the Buffett quote is diversification is for everybody who doesn't know what they're doing. I see it more like a reverse funnel. Like your money is coming down. If you spread your money out so thin that it doesn't actually trickle down and sink, you don't really make progress, right? So like if you spread out your ability, you end up pushing everything to the side as opposed to actually increasing and moving forward. So say it how you want. Closed-end funds, they work for us very well. And it's much easier, much simpler. It's so much easier to manage your own stuff. So if you like the content, consider subscribing to my channel, then head over to Facebook and join my group there called Navigate Your Finances. I break up what I teach. I talk earned income, like primary job and side hustle income, along with passive income on Facebook. And I talk financial strategy for closed-end funds, and then breaking down financial memes on YouTube. And both outlets give me a good ability to really sift and strategize through all parts of the financial system. As you go on your journey, remember you're the captain of your ship, and you have the power to change your life and your financial future. Many people will offer to help you. If you want to see how many people want to help you, just check out Pinterest and these not 150, now like 450 different memes on just this one board. But then you've got YouTube, you've got Facebook. There are people everywhere who want to give you advice. Find people that make sense to you. Find people that challenge you. Find people whose teachings align with yours and will help you get where you want to be. And then once you find that group, listen to them and sift their knowledge, right? And then make the choices that will improve your life, right? So whatever you're going to do, know your investment strategy, have a clear vision. And if nobody else can see your vision, that's fine, but you need to be able to explain your vision. If you can't make sense of your vision to yourself, then you're not going to be able to tell somebody else about it. So know your strategy, know what you want to do, know where you're headed, right? And then make it happen. Shock your world. It is so much easier to change, just your overall financial destination. It's so much easier than you believe. So this is Daniel Young signing off. I will see y'all on another video. Bye-bye.